Section 4. Building legal compliance and risk mitigation frameworks for lenders. Best practices for lenders to comply with state and federal regulations. During foreclosure proceedings, lenders involved in foreclosure proceedings must operate within a stringent legal framework to avoid legal pitfalls, mitigate risks, and ensure compliance with both state and federal regulations. Adhering to best practices not only helps prevent legal consequences, but also improves the efficiency and success rate of foreclosure proceedings. Key best practices for lenders. Follow state-specific foreclosure laws. Example: Arizona follows a non-judicial foreclosure process under ARS, paragraph 33.808 for most residential properties. Lenders must comply with the state's specific procedures, such as providing the borrower with proper notice of default and intent to foreclose. Any deviation from these procedures could lead to the dismissal of the foreclosure or delay the process. ARS reference. ARS, paragraph 33.808, Notice of Trustee's Sale, outlines the requirements for giving proper notice to the borrower and recording the notice with the county recorder. Failure to follow this law could lead to complications and challenges to the foreclosure process. Adhere to federal regulations. Example: the Home Affordable Modification Program, HAMP, and Home Affordable Refinance Program, HARP, are federal programs designed to assist homeowners in distress. Lenders must be aware of these programs and provide eligible borrowers with the opportunity to apply for these relief options. Non-compliance with these programs can result in penalties and a tarnished reputation. Regulation. The Dodd-Frank Wall Street Reform and Consumer Protection Act, 2010, includes provisions that affect foreclosure processes. These regulations include requirements for lenders to evaluate borrowers for loan modifications before proceeding with foreclosure and restrictions on dual tracking, simultaneously pursuing foreclosure while reviewing modification options. Proper notification and documentation. Best practice. Lenders must send out all required notices within the timeframes specified by state law, such as the notice of default and notice of trustee sale, and keep proper documentation. Failing to provide timely and correct notifications can lead to delays or even legal challenges. Example: in Arizona, the Notice of Trustee Sale, NOTS, must be mailed, posted, and published in accordance with ARS, paragraph 33.808. Lenders must ensure all forms are completed correctly and follow the necessary steps to avoid invalidating the foreclosure process. Proper handling of borrower requests. Best practice. Lenders should comply with borrower requests for loan modifications or payment deferments before proceeding with foreclosure, especially when the borrower has applied for a government program such as HAMP. Example: if a borrower applies for a loan modification, but the lender proceeds with foreclosure before reviewing the application, it could result in violations under federal regulations. Lenders must ensure that all borrower applications for assistance are processed in a timely manner to avoid dual tracking violations. Work with legal advisors to ensure compliance. Best practice. Lenders should consult with legal professionals who are familiar with state and federal laws related to foreclosure. This can help prevent costly mistakes and ensure full legal compliance. Example: in cases where the lender needs to pursue a deficiency judgment, legal advice is essential to ensure the right to pursue this action and comply with any applicable anti-deficiency laws, such as those in ARS, paragraph 33.810G, Anti-Deficiency Statute for Non-Judicial Foreclosures in Arizona. Legal frameworks for managing distressed loans, including modifications and foreclosure alternatives. Lenders must implement sound legal frameworks for managing distressed loans, particularly as they navigate through modifications, short sales, and foreclosures. These frameworks should prioritize compliance with laws while also providing borrowers with alternatives that can help mitigate financial strain and reduce losses for the lender. Key legal frameworks for managing distressed loans, loan modifications. Legal framework. Loan modifications are a critical component of managing distressed loans. Under federal programs such as HAMP and HARP, lenders are encouraged to offer modifications to borrowers who meet specific eligibility criteria. Example: a homeowner struggling with an adjustable rate mortgage, ARM, may qualify for a modification under HAMP, which may lower the interest rate or extend the term of the loan. Lenders must follow the federal guidelines for these programs and ensure compliance with relevant regulations to avoid potential penalties or lawsuits. Key laws. The Dodd-Frank Act, 2010, requires that lenders evaluate loan modifications before initiating foreclosure proceedings. HAMP regulations mandate that lenders must offer modifications to eligible borrowers who apply, and they must be transparent about the terms of modification offers. Short sales. Legal framework. Short sales are often a preferable alternative to foreclosure. In a short sale, the lender agrees to accept less than the full mortgage balance to avoid foreclosure. Lenders must evaluate short sale offers based on financial hardship and the market value of the property. Example: if a borrower owes $300,000 on a mortgage, but the home is only worth $250,000 in the current market, a short sale might allow the homeowner to sell the property and pay the lender $250,000, with the lender forgiving the remaining $50,000. Key laws. ARS. Paragraph 33-814. G. Outlines the conditions under which lenders can pursue deficiency judgments after a short sale. FHA short sale guidelines require that the lender follows specific rules regarding the approval and documentation of short sales. Forbearance programs. Legal framework. Forbearance allows borrowers temporary relief from mortgage payments, often due to a financial hardship like job loss or illness. During forbearance, the lender agrees to suspend or reduce payments for a set period. Example: a borrower who loses their job may qualify for a forbearance plan, allowing them to skip payments for 3 months. At the end of the forbearance period, the borrower may be required to resume payments or enter into a repayment plan to make up the missed payments. Key laws. Under HAMP, lenders are encouraged to offer forbearance as part of their loan modification programs. The CARES Act 2020 provided temporary forbearance relief for federally backed loans during the COVID-19 pandemic, requiring lenders to pause foreclosure actions for a set period. Pre-foreclosure counseling and assistance. Legal framework. Lenders must ensure that borrowers are given access to counseling or assistance programs before initiating foreclosure proceedings. This includes informing borrowers about available alternatives like loan modifications, short sales, and forbearance. Example: a homeowner who is behind on payments may be eligible for pre-foreclosure counseling through government programs such as the Homeownership Counseling Program, which offers free counseling to help homeowners avoid foreclosure. Key laws. The Homeownership Counseling Act 2010 requires that lenders provide access to counseling services for homeowners who are facing financial hardship. The Dodd-Frank Act mandates that lenders notify borrowers of their rights to seek foreclosure alternatives and counsel before proceeding with foreclosure. Voluntary foreclosure alternatives. Legal framework. In addition to short sales, voluntary alternatives to foreclosure may include deed in lieu of foreclosure, where the borrower voluntarily transfers ownership of the property back to the lender. This option avoids foreclosure proceedings but still impacts the homeowner's credit. Example: a homeowner who is underwater on their mortgage may opt to surrender the home to the lender via a deed in lieu of foreclosure, thereby avoiding the full foreclosure process. The lender may then sell the property or dispose of it through a different method. Key laws. ARS. Paragraph 33-818, Arizona, allows for deed in lieu of foreclosure transactions to be completed legally. Fannie Mae and Freddie Mac guidelines for deed in lieu transactions provide lenders with specific procedures to follow when a borrower surrenders property. Key takeaways for lenders. Lenders must ensure compliance with both state and federal regulations to avoid legal risks during the foreclosure process. Effective risk management strategies such as loan modifications, short sales, and forbearance can help reduce losses and provide viable alternatives for distressed homeowners. It is critical for lenders to understand the legal framework surrounding foreclosure, including deficiency judgments, debt forgiveness, and foreclosure alternatives like deed in lieu of foreclosure. Establishing strong legal protocols and providing transparent communication to borrowers can help maintain positive relationships and minimize litigation risks. By implementing these strategies and adhering to legal requirements, lenders can more effectively manage distressed loans, reduce financial losses, and maintain compliance with all applicable regulations. Mitigating risk in loan servicing, ensuring proper documentation and reporting. During the short sale process, lenders involved in short sales must adhere to stringent documentation and reporting requirements to ensure the process is handled correctly and compliantly. Failure to follow these requirements can expose lenders to legal, financial, and reputational risks. Below are some best practices to mitigate risk during the short sale process. Best practices for proper documentation in the short sale process. Complete and accurate documentation. Explanation: lenders must ensure that all documentation related to the short sale is properly completed, filed, and maintained. This includes the homeowner's financial information, hardship letter, tax returns, and evidence of any other financial obligations or assets. Example: If a lender receives a short sale application, they should verify that the borrower has submitted the necessary financial documents, such as proof of income, pay stubs, bank statements, and a hardship letter. These documents must align with the borrower's claims to ensure the request is legitimate. Risk. Failing to properly document the borrower's financial status can lead to legal challenges, delayed processing, and the potential for the short sale to be rejected. Clear communication and record keeping. Explanation. Throughout the short sale process, clear communication between the borrower, real estate agent, and the lender is vital. Proper records of all communications, emails, phone calls, letters, should be maintained to ensure transparency and avoid disputes later. Example. A lender should track every interaction with the borrower and real estate professionals. If the borrower submits an offer to purchase the property, the lender must clearly communicate whether it is accepted, rejected, or needs further negotiation. This documentation can be crucial in the event of disputes. Risk. Inadequate or unclear communication can result in misunderstandings or missed opportunities, ultimately jeopardizing the short sale and leading to possible lawsuits or regulatory penalties. Timely and accurate reporting to regulatory bodies. Explanation. Lenders must report the status of short sale transactions to regulatory bodies within specified timelines. This includes ensuring the property's status is accurately recorded in the mortgage servicing system. Example. A lender must update its internal systems to reflect the short sale approval and notify the relevant regulatory agencies, such as the Consumer Financial Protection Bureau, CFPB, within required timeframes. This helps the lender remain compliant with reporting and ensures the process is handled in accordance with federal and state laws. Risk. Failure to report timely or inaccurately can result in penalties from regulators, including fines and increased scrutiny of the lender's practices. Proper review and approval of short sale terms. Explanation. Every short sale offer must be reviewed in detail, and all terms must be approved by the lender before proceeding. This includes evaluating whether the offer aligns with the lender's minimum acceptable amount and ensuring that any potential deficiencies are addressed. Example. If a homeowner owes $200,000 on a mortgage but the property is being sold for $150,000 in a short sale, the lender should review the offer in light of the homeowner's financial condition, the property's market value, and the costs associated with foreclosure versus short sale. Risk. Lenders who fail to conduct proper reviews may inadvertently accept deals that result in financial loss, legal disputes, or even reputational damage. Understanding compliance requirements for lenders, handling second liens and mortgage-backed securities, MBS. Lenders involved in second liens and mortgage-backed securities, MBS transactions must carefully navigate a complex regulatory landscape to mitigate risk and comply with legal requirements. Understanding these compliance requirements is essential for avoiding legal pitfalls and protecting investors. Compliance challenges for second liens. Priority of claims and subordination risks. Explanation. Second lien holders must understand that their claims are subordinate to the primary mortgage, and if the property is sold for less than the primary loan balance, they may receive little or no payment. This subordination risk increases if the first lien holder forecloses. Example. A second lien holder who holds a lien for $50,000 might be at risk of receiving nothing if the property sells for less than the primary lien amount during foreclosure. In a short sale, the lender may only recover a fraction of this amount or nothing at all. Compliance issue. Lenders holding second liens must ensure that they are in compliance with state and federal laws regarding lien priority. If the second lien is to be included in a short sale, the lender must be certain that the terms comply with the Fair Debt Collection Practices Act, FDCPA, and Home Affordable Modification Program, HAMP guidelines. Disclosures and transparency in second lien transactions. Explanation. Lenders must ensure that they provide full disclosure of all terms related to second liens, including the balance, interest rate, and payment schedule. These disclosures must be transparent to all parties involved. Example. In a short sale, if the first lien holder is forgiving a portion of the loan, the second lien holder may also need to negotiate for forgiveness. Lenders must disclose the terms and potential consequences of these negotiations to avoid future disputes. Compliance issue. Failure to properly disclose the terms of second liens can lead to legal disputes and a violation of state and federal consumer protection laws, such as the Truth in Lending Act, TILA, and Dodd-Frank Wall Street Reform and Consumer Protection Act. Compliance challenges for mortgage-backed securities, MBS, proper securitization of loans and regulatory oversight. Explanation. When mortgages are bundled into MBS, the loans must be properly securitized in compliance with Securities and Exchange Commission (SEC) regulations. This includes ensuring that the mortgages meet the required standards for MBS and that all disclosures are accurate. Example: a lender must verify that the mortgages included in the MBS are compliant with the underwriting standards set forth by the government-sponsored enterprises, GSEs, such as Fannie Mae and Freddie Mac. Any failure to comply with these standards could result in the invalidation of the securities and lawsuits from investors. Compliance issue: lenders must ensure that all MBS are properly structured and documented to comply with the SEC's Regulation AB, which governs the offering and disclosure of asset-backed securities. Non-compliance can result in significant legal consequences. Monitoring of loan performance in MBS portfolios. Explanation: lenders and servicers must continuously monitor the performance of loans within the MBS portfolio. This involves tracking defaults, delinquencies, and foreclosures to ensure that the MBS are performing as expected. Example: if a significant portion of the loans within an MBS portfolio defaults, the lender may need to work with investors to restructure the securities or offer loan modifications to keep the portfolio stable. Compliance issue: under Dodd-Frank, lenders must ensure that they are not misleading investors about the performance of the MBS. Failure to report accurately could result in investor lawsuits and penalties from the Consumer Financial Protection Bureau, CFPB. Investor protection in MBS. Explanation: MBS issuers must ensure that investor interests are protected and that the mortgages included in the MBS are of the highest quality. This includes ensuring that the borrowers in the MBS portfolio are not overly risky or likely to default. Example: if a lender bundles subprime mortgages into an MBS, it must disclose the risks associated with these loans to investors. If the lender fails to disclose these risks and the MBS performs poorly, the lender could be held liable for damages. Compliance issue: lenders must comply with SEC Rule 15c28, which requires full disclosure of risks to investors. Failure to do so can result in civil penalties and lawsuits from investors. Wheel title: MBS issuers must ensure that investor interests are protected and that the mortgages included in the phrase MBS are of the highest quality. Key takeaways for lenders. Second liens. Lenders holding second liens must be aware of the risks associated with subordinate claims and ensure compliance with lien priority rules and full disclosure of terms to all parties involved. Mortgage-backed securities, MBS. Lenders must ensure proper securitization of loans and adherence to SEC regulations to protect investor interests and maintain the integrity of the securities. Compliance. Lenders must stay current with state and federal regulations governing second liens, MBS, and foreclosure processes to mitigate risk, maintain legal compliance, and avoid penalties. By understanding and implementing these compliance frameworks, lenders can manage distressed loans, mitigate financial losses, and protect both themselves and their investors from legal and financial risks. Summary: navigating short sales, foreclosures, and the associated financial implications. Over the course of this comprehensive study, we've explored the intricacies of short sales, foreclosures, and the impact they have on homeowners, lenders, and buyers. Below is a summary of the key points covered, designed to consolidate everything into a cohesive understanding. Financial outcomes for homeowners. Credit impact. Both short sales and foreclosures damage credit scores, but foreclosure tends to have a more severe impact, dropping credit scores by 150-300 points compared to 50-150 points for short sales. While foreclosure stays on the credit report for 7 years, short sales may allow for quicker recovery, with the potential to qualify for new credit in 2 to 4 years versus 5 to 7 years for foreclosure. Debt forgiveness. In short sales, the lender may agree to forgive the remaining balance, the deficiency, between the sale price and the loan balance. However, this forgiven debt can be taxable under federal tax laws, Form 1099-C. Foreclosures may result in deficiency judgments, where the lender seeks the remaining debt, but states like Arizona have anti-deficiency laws to protect homeowners in certain situations. Impact on lender subordination, risks, and secondary liens. Second lien holders, junior liens, are at risk in short sales and foreclosures because they only get paid after the primary mortgage is settled. If the home is sold for less than the primary lien balance, the second lien may receive nothing. Unsecured debt. When the home's sale price doesn't cover both the first and second liens, the second lien becomes unsecured debt. The lender may have to pursue legal action to recover any remaining balance, which can be time-consuming and costly. REO properties. After a foreclosure, lenders often take ownership of the property as a real estate-owned REO asset. These properties may need to be sold at a loss, and lenders sometimes write off these losses or use mortgage insurance, PMI, to recover part of the cost. Impact on buyers' financial risks. Distressed properties, whether short sales or foreclosures, are often sold below market value, offering potential savings for buyers. However, these properties may come with hidden defects or unpaid liens. Buyers must be prepared for unexpected repairs and complications related to title issues or lack of inspections. Financing and property condition. Financing for distressed properties can be challenging, with many lenders requiring cash offers, hard money loans, or government-backed loans. Buyers must be aware of the potential for costly repairs and the as-is condition in many foreclosure purchases. Legal and ethical considerations. Homeowner protections. Homeowners in some states are protected by anti-deficiency statutes, which prevent lenders from pursuing deficiency judgments after foreclosure. It's essential for homeowners to understand these protections and work with professionals who can help them negotiate the best terms. Ethical duties for real estate professionals. Real estate professionals must maintain transparency and fairness when working with distressed properties. This includes adhering to ethical guidelines, ensuring full disclosure to all parties, and avoiding conflicts of interest or fraud during the process. Buyers' legal challenges. Buyers need to be aware of the potential legal challenges when purchasing distressed properties, including title issues, as-is sales, and understanding their obligations in foreclosure and short sale transactions. Strategies for risk mitigation. For lenders can mitigate risk through proper documentation, risk assessment, and effective use of mortgage insurance, PMI. They should also understand the implications of second liens and mortgage-backed securities, MBS, to protect their investments. For homeowners should explore options like short sales and government programs, HARP, before resorting to foreclosure. Consulting tax professionals, understanding bankruptcy options, and negotiating debt forgiveness can help reduce long-term financial damage. For buyers should assess financial risks carefully, secure proper financing, and be prepared for hidden costs and repairs when purchasing distressed properties. Working with legal professionals to clear liens and ensure clear title is critical. Conclusion: understanding the full picture. Navigating short sales, foreclosures, and distressed property transactions requires a deep understanding of financial risks, legal obligations, and ethical responsibilities. Homeowners must weigh the consequences of each option, whether it's a short sale or foreclosure, and actively seek professional advice to protect their financial future. Lenders need to implement effective risk management strategies, especially when dealing with second liens and mortgage-backed securities, to minimize potential losses. For buyers, while distressed properties present opportunities for savings, the risks involved, such as hidden repairs and financing challenges, must be carefully managed. Real estate professionals, on the other hand, play a pivotal role in guiding homeowners, lenders, and buyers through the complexities of distressed property transactions. Their adherence to ethical standards, legal compliance, and best practices will not only protect their clients, but also ensure that these transactions are conducted in a fair and transparent manner. In the end, understanding these intricate financial, legal, and ethical factors will enable all parties to make informed decisions that minimize risk and promote positive outcomes, whether for homeowners facing financial strain or for buyers seeking investment opportunities in distressed properties.